Jason, from a broader asset allocation perspective, it was all tech going into the summer. Valuation premiums have come down, but is it a place where you feel like it merits a big bet right now?
So the valuations are still a little bit rich. If you just look at tech versus the overall market, it got up to like a premium of say like 15%, and maybe now it's like at about 5%. So you can't say tech as a sector overall is cheap relative to the market. Then there's the question, and this applies I think to markets in general, is that increasingly we're pricing in kind of a recession almost as a base case. And tech, even the secular growth stories aren't immune in that scenario. So right now I think for tech to kind of outperform, in general you need kind of comfort that the cycle is not ending, and you need sort of better data on that front. Right now it's going to take a couple of months before I think kind of investors get comfortable. Valuation alone is not a sort of a reason for, I think, for people to buy.
And just to be clear, do you think right now the market is priced as if recession's a base case? Because, I mean, yeah, it's 20% in 3 months, but, we'd have to live through a lot of bad before you got to recession.
Not necessarily the base case, but if you're looking at, say it's a 30 or 40% chance that in 12 months we'll get a recession, whereas most economic models that try and forecast are saying the probability of recession is like, 15% in the next year. So there's definitely this disconnect between what the economic data is seeing right now and versus what the market's pricing.
Paul, I know you've been sort of in the wait to buy camp for a while. We've spoken a few times now. Has the damage been kind of widespread enough for you to change that at this point?
Well, the way I look at it is we're going to get another data point from not just the major tech companies, but from most tech companies, and that's going to come probably fast and furious beginning in about the third week of next month. And with all the political instability, and I'm focused on that, I don't believe that we are going to eke ourselves into a recession. I think we're going to grow U.S. real GDP at about 2% next year, which is, yes, going to be down from 2018, but it's also going to be much better than the rest of at least the developed world. And so I think at some point, and I'll be the first one to get on the air and tell you when, that technology will be rebounding, and it may be, when we get to December 31st of 2019, the best sector of the 11. But to tell you the truth, Mike, I've seen a lot of this. I think the fundamentals are okay, not great. I think the valuation is very intriguing, but I need to see at least some more data, whether it be macroeconomic or microeconomic, that gives analysts on Wall Street a chance to, yet again, lower their revenue and EPS estimates for the future. And then once we see that catalyst, it may be time to go all in.
Paul, I wonder, we talk so much about hedge fund exposure and how it impacts overall pricing in tech. Do you think the easier trade for some of these funds is going to be to flip back into the Western Diges and the Microns, or stick with the Adobes and Microsoft that have been hit less on a relative basis?
I think the business models are more stable for some of those software as a service companies rather than the semiconductor companies. With the semiconductor and the semiconductor capital equipment companies, you really have to be spot on calling the cyclical turn. And I'm not comfortable there yet, but I am pretty comfortable if you have a long-term perspective, even today, buying Adobe, Autodesk, Microsoft, and some of that ilk.
It's curious because there's been so much volatility. If investors don't have the stomach for that, even some of the stable sectors have been on some shaky ground. We've seen some slippage in utilities and consumer staples. Is there a place to ride out 2019 where you don't rock and roll all the time?
In terms of sectors, if you just look over the past couple of weeks, it's been sort of very almost idiosyncratic. You've had some defensives do well, others not. You've had some kind of more cyclical stocks doing well, and others haven't. So it's been kind of hard to get a read, which is why I'd almost sort of discount a little bit of the price action in the past 2 or 3 weeks. I think there's, light volumes have been a factor. If you think about overall sectors, though, having almost more maybe a bit of a barbell approach, something that can give you kind of play to cyclical growth, sort of a reacceleration there, but also at the same time something that's going to be a little bit more defensive.
Like what?
So in terms of cyclicals, thinking about sectors that could be, in sort of the tech space that are kind of a little bit more immune to kind of the global cycle. So Paul kind of alluded to, I think, IT spending in the cloud space. That's something that can kind of do well if the economy stays strong. On the more defensive side, something like staples versus utilities, which have actually become quite expensive relative to the market. So I think we're at a point where you have to kind of be a little more selective, both across sectors and within sectors, what looks attractive.
And when you're looking at these sectors, Paul, how much are you looking at leverage and how highly leveraged some of the companies are, or as a sector, how highly leveraged they are?
That's an excellent question, because when you take a look at these balance sheets, particularly as folks become a little bit more worried about the macroeconomic, they are going to shift away from the weaker balance sheets. So yes, particularly in this environment, an excellent question that you ask. I am very wary of companies that are leveraged too much.
Go ahead.
But on that point, I think actually if you look at companies that have weaker balance sheets, like more debt outstanding, versus those that have strong balance sheets, the market's been differentiating from that. And I think it speaks to the fact that people are getting more concerned about the credit markets. We've gone a month without any high yield issuance. So there's signs where people are worried about, could the credit markets roll over? And if you have exposure, if you have a lot of debt outstanding, you can't refinance it. Those companies are going to be hit harder. So again, it becomes almost a little bit of a stock picker's market in terms of like differentiating between those can be immune from sort of weaker growth versus those that are going to be kind of impacted the most by it.
Jason, you win points with the interviewer if you say, excellent question. I'd like to,
Excellent.
Yeah, Paul did that very well. It's almost as though you've learned from somebody.
I'm a veteran.
Stroke the host a little bit. Yeah, it was really good, Paul. Thank you so much for that.